All right, it's time. All right, I see there's only two of you, so we'll give it a couple of minutes. And then in the meantime, I'll just set up here. And well, let's see, where were we? Chapter 14, I believe. So let's get back there. We're looking at covered interest parity, or actually I should say covered interest arbitrage. And let's see. So we'd already done triangular arbitrage, and we looked at, yeah, here we go, interest rate parity. So this is something we'd started it. I don't think we completed it though. And we also have after this the uncovered interest rate parity, which is something a little bit different. And then in 14b, what we're going to be looking at is actually models that help us explain how and why exchange rates are determined the way they are. In other words, we take them for granted, but we want to understand the economic factors that determine the strength of different exchange rates. And so this is a model that is pretty widely used in international finance to help us understand how, at least in the short run, exchange rates are determined. All right, so we'll get to that in a bit, but first we want to go back and continue our discussion about interest rate parity. So let me just go back quickly and remind you what we were talking about. So the word parity, as you know, simply represents a balance of some kind. Now, in some cases, in economics, sometimes it's used a little bit inconsistently, I think. Here, it implies that there's a no arbitrage relationship of some kind, which means that if it's violated, that would indicate that we could earn risk-free profits. Other times, you'll see later in the course, there are parity conditions that do not involve arbitrage at all. So you can't assume that the word parity always means arbitrage-free, but frequently it does. In this case, it certainly does, interest rate parity, because we're looking at a no arbitrage relationship between spot exchange rates and forward exchange rates. Okay, so you might recall, just briefly, I'll just remind you that the distinction that we make here is that a spot exchange rate is the price of a currency that is bought or sold for immediate delivery. And of course, immediate means within 2 business days. It doesn't mean literally right on the moment. Up to 2 days is considered to be immediate. A forward exchange rate is the price of a currency that is bought or sold for delivery in the future. Now, when we say the future, typically the most common maturities are 30, 60, 90, maybe 120, 180 days. And in other words, at least a month in the future is what we're really talking about here. And so they're very important because forward exchange rates, that is, because with a forward exchange rate, what this enables us to do, a forward exchange rate applies or is used to determine the price that will be paid or received for a currency where delivery has been arranged through what we will call a forward contract. Okay, so we talked about forward contracts. A forward contract means you enter into this contract and you agree to buy or sell a currency in the future, but the price is settled today, all right? And so this, a forward contract can be used to eliminate foreign exchange risk. That's the whole point, foreign exchange risk. So now the volume of trading in forward contracts compared to the spot market is not that high. In fact, I came across a very interesting chart in one of my other classes today. In fact, why don't I go show it to you because it's directly relevant to what we're doing here, which will show you the composition of the hold on, of the what is actually being traded in these foreign exchange markets. So hold on one second. Let me go get you this chart, which I think you'll find to be very interesting. All right, here we go. So I'm teaching a similar class in the daytime at another school, but I found this. Here it is. Let me just copy this into your slides. Where now I lost it. Here it is. Here it is. All right. So let's take a look at this chart. Now, this is as of 2013, as you can see, but it's still fairly recent. Now, we have not discussed what a foreign exchange swap is, by the way. Let me just briefly introduce that to you because it's directly related to what we're doing here. And by the way, this is an unfortunate choice of name, I must say, because there's two types of swaps that contain the name foreign exchange. So this type of foreign exchange swap means an agreement in which a currency is bought or sold today, and then actually let me just take a step backwards here, in which either a currency is bought today and then resold in the future, or a currency is sold today and then repurchased in the future. It could go either way. Okay, now what's the point of this? All right, so let me show you an example of this. Suppose, for example, that an American importer agrees to buy 100,000 British pounds. Let's see if I can find that symbol. Yes, 100,000 British pounds today for, let's say, $140,000, and also agrees to sell them back in, let's say, 60 days for, let's say, $135,000. Okay, so what this means then is that we're not only agreeing to buy the pounds now, but we're selling them back in 60 days because we don't need them. We only need them for 60 days for whatever reason. So this means you've got both a spot and a forward exchange rate in the same contract. Okay, the spot exchange rate is $1.40 per pound. And at the same time, the 60-day forward exchange rate is obviously $1.35 per pound. So the foreign exchange swap contains both a spot and a forward transaction. So it's kind of interesting. It's a hybrid of both. In other words, we have a spot transaction, we have a forward transaction. Here we have both at the same time. All right. So having said that, if you look at this chart, this must be a very popular arrangement because you can see that most of the transactions in 2013 were in fact foreign exchange swaps. Okay, so we had $2.28 trillion worth of swaps. Spot transactions were about slightly over $2 trillion. Forward transactions about 680. And then these, we will investigate these later on. These are derivative securities that give you the right to buy the currency, but not the obligation. These only amounted to about $337 billion, which is still a lot when you consider these are daily transactions. This is not per year. This is every day. This is $5.3 trillion. Does that seem like a lot? $5.3 trillion every day changes hands in these markets. And not only that, but unlike the stock markets, for all practical purposes, the foreign exchange markets never close. Because if you are, let's say, in the New York time zone, and you want to trade during the middle of the night, all you have to do is go to the Tokyo exchange and you can trade all you want, or London, depending on what time it happens to be. So these are massive amounts of trading. And so we're going to try to answer the question why during the next couple of chapters. Why is there so much trading here? Because this is way, way more than the world volume of trade. Only a very small percentage of this is being done to finance imports and exports. The rest, what's going on? Why are all these funds floating around like this? Well, we're going to try to answer that question in a couple of different ways. But in the meantime, so you can see the sheer volume of this market is just astronomical. So anyway, anyway, it turns out, though, that as far as the spot and forward exchange rates go, they're tied to each other by a very specific, very precise mathematical relationship, which is known as interest rate parity. And so let's take a look at it again. We've seen it before, but we're going to look at it again. And so the formula is this. Now, with this this formula, I by the way, just want to take another step back and just remind everybody that there are different interest rate conventions that we could potentially encounter in the financial markets. Let me just show you two of the basic types. Okay, we could have what are called discretely compounded rates and what we could call continuously compounded rates. So what's the difference between the two? All right, well, here's how this works. Suppose, for example, that $1,000 is invested in, I don't know, a stock, and let's say that let's say it is sold for $1,100 1 month later. Okay, what is the rate of return to this stock? All right, so here's what we're going to do. We're going to approach this in two different ways. Using discretely compounded rates, the return is, okay, so it's the new price minus the original price, all divided by the original price, which is 100 over 1,000, which is 10%. All right, so this is the monthly return. If you wanted to annualize it, you could certainly feel free to do so, but the monthly return to the stock is 10%. In other words, you put your money in, it's like putting your money in a bank account. If you could get this kind of return in a bank, it would mean that you put your money in the bank for a month and your $1,000 becomes $1,100. This is compared to the discrete compounding, the continuous compounding, which we'll do next. The continuously compounded return is equal to, so what we have to do here is take the natural log of the new price over the original price. And then when you do that, you get 0.0953, which is 9.53%. Now, you might say that that's a smaller amount, but it actually isn't. And here's why. The way that you have to think about this is that the monthly case means a monthly return of 10% means that at the end of 1 month, investor earns 10%. A continuously compounded return of 9.53% means that the investor is earning interest at a rate of 9.53%, but on a continuous basis, meaning at every instant in time, they're receiving a proportional share of this 9.53%, so that at the end of 1 month, the investor will have, so we have $1,000. Instead of multiplying it by 1 plus 10%, we're going to take E and raise that, let's see, to the, I forgot this. I need to take an extra step to have a superscript in PowerPoint. We're raising this to the 0.0953 power. So let me, wow, running out of space here. So I'll have a superscript. And if you multiply that on your calculator, you're getting $1,100. Okay, so the difference between the two cases is that with the 10%, it all gets paid at the end of the month. Here, you're getting a proportional amount of this 953 every instant in time throughout the entire month, and you end up with the same result. So that means that 10% compounded monthly is the same as 9.53% compounded continuously. Now, with many different models in finance, continuously compounded rates have several convenient mathematical properties that we don't get. The discrete rates do not have. I think I may have already shown you this example once before, but let's just check this out. Another example, just to show you what I mean by convenience. Let's take a look at as an example of this. So imagine an investor buys a stock for, let's say, 100 and sells it a year later. Well, actually, no. Buys a stock for 100. At the end of 1 year, the stock sells for 110. At the end of the second year, the stock sells for 100. Now, clearly, his total return is 0. But what if we tried to figure this out using these two conventions? All right, watch this. Using annual rates of interest. All right, I guess what I should say is annually compounded rates. We have, so during year 1, the return is 110 minus 100 over 100, which is 10%. Okay, but during year 2, the return is 100 minus 100, 100 over 110, which is a loss of 9.09%. So what this implies, okay, is the following paradox. Okay, this implies a 2-year return of 10% the first year minus 9.09% in the second year is a gain of 91%, which we know is nonsense because we got right back to where we started from, which is a 0% return. But with continuously compounded rates, we have, during year one, we have a return of the natural log of 110 over 100, which is 0.0953. And during year two, the return is the log of, that's again, it's the ratio. This should be the ratio of the year one price over the year two price. Let's see. So this is going to be negative 0.0953 or negative 9.53%. So you can see the total 2-year return in this case okay, 9.53% minus 9.53% equals 0%. Okay, so you can see there's a problem with discretely compounded rates. And so often continuously compounded rates are the preferred choice in the financial markets because you can see what happened here. The problem with the discretely compounded rates is this. Do not take into account that the balance in an account will change based on its rate of return over time and will tend to overstate the true rate of return. All right, so that doesn't mean we shouldn't use them ever, but I mean, for certain situations, we'd like to use continuously compounded rates. And in particular, this is something else I may have mentioned last week, that we tend to see continuously compounded rates used in derivative securities pricing models because of the mathematical convenience. Okay, now you might recall that last time, somewhere back here, when we introduced forward exchange rates, I believe we did use continuously compounded rates to show the interest rate parity condition. Let me just go find it real fast. Maybe not. I thought I did. Let's go back to the beginning here. Oh, well, maybe not. But anyway, it's important to be aware of the two different kinds of interest rates that we could potentially run into. But anyway, so what I really want to show you next is that with this interest rate parity condition, even in spite of the problems with discretely compounded rates, by tradition, we typically use discretely compounded rates to derive this interest rate parity formula. So this is what it looks like. Now you can see by the way it's written, it is based on discretely compounded rates of interest. And more particularly, what it's showing us is that we're assuming that the interest rates in this formula are based on a 360-day year. Now, we know that that's not obviously the case, but if you look at all the different markets in which interest rates are quoted, you can see that for some of them, we use a 360-day year, sometimes 365. Some of them we use what's called actual, which means in a leap year, there'd be 366. And we also see different conventions for the months. So in some cases, we use 30 days, and sometimes we use what are called actual days. So the markets here, these interest rates are themselves taken from the so-called euro currency markets, which are based on 3360. All right, remember, a euro currency, as I'll remind you, is simply a deposit held outside the country of origin. So in other words, for example, dollars held in Royal Bank of Scotland in London are considered to be euro dollars and earn the euro dollar rate of interest, which until recently, until I guess for another year or so, would be the LIBOR rate, the dollar LIBOR rate. Soon enough, that won't be true. I think we saw that in this class. We had a chart where I showed you the different names of the different rates that are coming along to replace LIBOR because of all the scandals. All right. You wouldn't think that there'd be room for scandals in such a market like this, but you'd be wrong. The banks found a way to manipulate the rates to take advantage of their clients. And so that's why we can't trust them anymore. And we have to use something other than LIBOR. So the euro currency markets are enormous. And so there's euro currencies and there's euro sterling for the pound and there's euro yen and there's everything. So the rates of interest in this interest rate parity condition are in fact euro currency rates. I mean, even if we call it domestic means in our case euro dollars. Our star, if we're looking at the pound, would be euro sterling. All right, so that's how this formula is set up. So the euro currency markets have what's called a day count convention. Of 3360. And so that's why the formula is set up this way. Now, F is the spot exchange rate. And then F must be the forward. Now here, this will be the end day forward exchange rate. And that means now R is the domestic, which in our case would be euro dollars. Our star could be the euro sterling rate if we're looking at the dollar pound exchange rate. Now this formula is based on discrete compounding, and it also is a no arbitrage relationship, because if it's violated, then that would lead to the opportunity to earn arbitrage profits, a very specific type of arbitrage profits. The question is how to take advantage of them. All right, so here's a numerical example that we started to work on. We've got 180-day Euro-dollar deposit rate is 2.89%. Now, by the way, that means per year. All interest rates are quoted on an annual basis. Because it's only 180 days, that means we're actually earning half of that if we keep our funds in a Euro-dollar deposit account. Same thing holds down here. So don't be confused when you see these. All right, so we have a rate for the euro sterling, and then we have a spot exchange rate between the dollar and the pound. So we're going to use this formula to figure out the implied forward exchange rate that should hold over those 180 days. All right, so we plug in the numbers, and if you do a little algebra, you can see that you should wind up with 1.8523. So this is the rate. You can say that this is the only forward exchange rate at which there are no arbitrage opportunities. All right, it's also the only rate, I'll add that down here, is also the only exchange rate or forward exchange rate at which investing in either currency provides the same rate of return. Now that assumes, though, that we eliminate our foreign exchange risk with a forward contract. Okay, if you just put your money in the, let's say, euro sterling and leave it there and don't cover your risk, there's no guarantee you'll get the same return as you would by keeping euro dollars. But if you do invest in euro sterling and you hedge your foreign exchange risk with a forward contract, then we can be sure that you'll get the same return from either currency. But only if F equals that number. If it equals something else, then you would be able to earn more in one country than the other, and that's the source of the arbitrage opportunities. So here we're being told that it's 1.8523, and of course anything else means that we might just find ourselves with a little profitable opportunity. All right, now the question is how to take advantage of that. By the way, I do want to point out one more thing here. This is kind of important because you know that exchange rates can be quoted as dollars per unit of foreign currency or the other way around. Here, what we're assuming is this. This is domestic. This is foreign. And then E and F will both be dollars per foreign currency, which I'll abbreviate FC. If not, so like, let's say this is so many dollars per pound. If that's backwards, let's say that the exchange rates we're looking at are foreign currency per dollar. Okay, so if let's say this is yen per dollar, and this is yen per dollar, if you notice the R star is now in the numerator. And the R is now in the denominator. So if the quote is foreign currency per dollar, that means you have to flip over this formula and use the foreign rate in the numerator and the domestic rate in the denominator. Otherwise, you're going to get it completely wrong. Now, having said that, in the past and this year as well, I will always make sure the examples are dollars per pound, dollars per Swiss franc, dollars per euro, whatever it is, so that this won't actually come up. But it's important to be aware of it. Okay. Now, The forward exchange rate, of course, is derived from the interest rate parity condition. And again, we can demonstrate very quickly and easily that if you do cover your foreign exchange risk with a forward contract and you invest at this forward exchange rate, you'll end up with the same rate of return in both countries. So I think we may have gone through this before, but let's go through it one more time because this will help us understand how the arbitrage works when it turns up. So you start out with these numbers. And again, remember, these rates are annual numbers. And R is the euro dollar rate, R star is the euro sterling rate, and the spot and the forward exchange rates are both based on dollars per pound. All of them have a maturity of 180 days. They have to all be the same, or half a year. Now, if we keep our money in euro dollars for 6 months or 180 days, how much will we have at the end of that time? Well, it turns out that if you're lucky enough to have $1 million and you put it in a euro dollar account for 180 days, you'll get $1,014,450. So what you've effectively done here is taken this 2.89% annual rate and cut it in half. Okay, 180 over 360 is clearly a half. And so when you multiply that out, you'll get 1.145%. And this is the final result. All right, now what if we had done the opposite? What if we decided that it might make sense to invest in euro sterling and yet cover our foreign exchange risk? Okay, so we don't want to invest without covering our risk because otherwise it's a completely different transaction than hanging on to dollars. Then you're comparing apples with oranges. So in order to do it with euro sterling, of course, the first thing we have to do is convert our dollars into euro sterling. And what rate will we do that at? That would be the current spot exchange rate. All right, so the first step would be to do the following. Convert your dollars into pounds at the spot exchange rate, invest them in a British account at the euro sterling rate, but, and this is the key to the whole thing, while you're doing this, you have to figure out how many pounds you'll have at the end of the 180 days and enter into a contract to sell that many pounds in 180 days. Okay, and that means using the forward exchange rate, of course, which is observable in the market today. And then by doing that, and then when you're done, at the end, what you have to do is, well, actually, no, you're done. If you already held the dollars, in some cases, you have to assume that the person is borrowing the money. And if that happens, then you have to pay it back at the end. Okay. But if you already had the dollars in your pocket, you could certainly just go ahead and do this, and you'll end up with a locked-in rate of return holding euro sterling. So let's do that with these numbers. So here's our spot exchange rate, and you notice how we have to divide, not multiply. You've got $1 million, and you multiply that by, you divide, right? You divide. Let me write it out properly. All right, let me fix this. I've written it as 1.8693 per pound. Now, algebraically, this is the same thing as multiplying by the inverse. And now you can see, no space here, you can see the dollars cancel each other out, and you're left with pounds. How many pounds? 1 million divided by 1.8693, which works out to approximately 534,959.61 pounds. Now, at this time, you're going to invest these pounds in a euro sterling account for 180 days. Now, because we already know what the rate of interest is, we know exactly how many pounds we'll have in 180 days. And in fact, we can figure that out right now. All right, let me give you a minute to catch up, and then we'll see how much we'll have in 180 days. That's how many pounds you have to sell forward to eliminate all of your foreign exchange risk. All right, so here we go. Let's see how that works. So the amount that you have today is invested for 180 days at this rate. That's the euro sterling rate, which is quite a bit higher than the euro dollar rate. So you know for a fact that in 180 days, you'll have this many pounds in your account. So while we're doing this, we also have to enter into a forward contract to sell 547,670.52 pounds at the forward exchange rate that we were just given of, what is it, 185.23. Okay, that's this point in time today. That's how much the forward exchange rate is for delivery in 6 months or 180 days. So how much will that bring us? So because the forward exchange rate is 185.23, now this time I'm multiplying, by the way. So my account in 90 days, or sorry, 180 days, will be worth 547, 670.52. And then I already know that those will be sold at the forward exchange rate of 185.23 per pound. These drop out. And when you multiply them together, you get a number that you should recognize. It's $1,014,450. It's the same. It's the same in both countries. And that's because I'm selling it with the correct or implied forward exchange rate of 185.23. But you can see that if this was anything else, either this amount would be too high or too low compared to what I could get in the United States. So there's a graph here that we're going to use to help us with these types of situations, just to help us visualize what's going on. This is the top represents investing in the US, meaning a euro dollar account for 180 days at this rate. As you've already seen, we'll end up with 1,014,450. If instead we choose to go and put our money in euro sterling and first exchange them, the current spot exchange rate, we earn the euro sterling amount of interest for 180 days, which brings us here. But then the key is here. This is today, by the way. This is in 180 days. Right here, once we swap these pounds for dollars for pounds, we also, right here at this point in time today, enter into that forward contract. And sell those pounds for this quote that we've been given. And that guarantees that we'll end up breaking even between the two transactions. Either way, we'll have the same amount, 1,014,450, which is how we know that that F is the correct one. Well, now, here's the big question. What happens if F is different? What if somebody gives us the wrong quote? What if they give us an F that's too high? And what if they give us a quote that's too low? How do we take advantage of that? We've already seen that this is a no arbitrage relationship. If it's violated, even by a small amount, we should be able to take advantage of it. All right. So obviously we have to come up with a strategy for both cases, too high and too low. All right. So let's try too high. F is 186. Somebody gives us a bad quote. We go ahead and take advantage of it. What does that mean? All right. Well, if we go ahead and buy pounds today, when we sell our pounds through a forward contract, we will receive, because of this high quote, more pounds. Okay, at F equals 186, the bad quote, then at the actual quote, which is what it should be, is 185.23. So that's kind of a hint that because we're being given the opportunity to trade our pounds for too many dollars, that means we must be selling pounds in order to make money. All right. In other words, the forward pounds are overvalued or overpriced relative to spot pounds. Now, we said earlier in the course that when something's mispriced, we buy whatever is underpriced, sell overpriced. And so here, we're buying the spot pounds and we're selling the forward pounds. If F is too low, of course, we'll do everything backwards from here. So why don't we see mathematically how this works out? Okay. So we're going to, now here we're going to assume that because this is an arbitrage, we're going to assume that we don't need our own money. We're actually going to borrow the dollars that we need to get this process started in the euro dollar market. All right. And you'll see that in spite of that, we're still going to make money. Even though we had to pay back a loan, we're still going to end up making a profit. So here we go. Let's go through these following steps. We start by borrowing $1 million for 180 days, and the rate of, this is the euro dollar rate. And then convert to this many pounds. This is the spot rate. This is actually what we were doing before. These are the same numbers. The difference comes at the end when we convert these back into dollars. All right, so we're going to deposit this in a euro sterling account for 180 days. And in 180 days, as we've already seen, these will be worth, as you can see down here, 547,670.52 pounds. So that means we're going to sell them through a forward contract. But guess what? The contract price is too high. So how much will these pounds be worth in 180 days? Well, let's find out. So in 180 days, you deliver these forward pounds through your contract, and you end up earning $1,018,667.17. Now, the dollars that you borrowed have to be repaid. But remember, in the US, the euro dollar rate is only 2.89%. So that means, which you remember from before, when you repay the loan, that's $1 million times 2.89%. And that's going to be less than this number. In fact, you'll recall this number. It's $1,014,450. So what just happened? Well, you somehow managed to arrange it so that no money came out of your pocket, and in 180 days, you're going to pay, or you're going to receive from your contract 1,018,667.17. So we collect 1,018,667.17, and we repay 1,014,450, and so our profit is 4217.17. Not bad. And this is a risk-free profit that did not involve any of our own money. And this is what we mean by arbitrage. Just because we noticed that the forward exchange rate that they quoted us was too high. It was just that simple. All right. We didn't do anything except take advantage of it. And we made all this money. Now, you notice we started with $1 million. What if we'd started with $100 million? Well, then you just multiply these profits by 100. So in principle, there's no limit to how much we can make from this. But once people start to notice this, they'll start doing the same thing. The prices will adjust, and eventually all the profits will be gone. So you can't expect this to last for any great length of time. In fact, in the real world, these kinds of things will show up for maybe nanoseconds. So only computers can realistically take advantage of them. Okay, so let's see. What would you, oh, and here's how this shows up in the graph. Okay, what's different now is get two different numbers here. The one on the top is what happens when you repay the loan. And the one on the bottom is collect from the forward contract. And so clearly that's a profit. Well, that's what happens. Okay, the quote is off, therefore we can make a profit. Now, if F had been too low, we would just reverse all of these steps. Okay. And we'd still make money. Let me get this out of here. Yes, so if F had been too low, we still could have made money, but we would have done it by going in the opposite direction. So in other words, let's just say, just as an example, F had been $1.85. What you could have done is buy the pounds in the forward market, sell them in the spot market, by which I mean buy them, borrow pounds, and sell or convert to dollars. Invest in a euro dollar account. And then sell dollars for pounds in a forward contract. And then repay the pound loan. And you would have ended up with money there too. So you're just reversing everything, except The only difference here is that your profit would be denominated in pounds instead of dollars, but it's still a profit, a risk-free profit, because now the forward pounds are underpriced relative to spot pounds. So your strategy is to sell spot pounds and buy forward. And that's exactly what this strategy does. All right. So either way, if F is too high, if it's too low, either way, we can make a profit if we recognize what we're doing. Oh, man. So that means it has to be exactly correct to avoid arbitrage. Okay. So now we're going to move on to a slightly different topic, which is uncovered arbitrage, or the so-called carry trade. This is a little bit different because it's not really an arbitrage, and also this was being done at a time when U.S. rates were much higher than Japanese rates. For the longest time, Japanese rates have been extremely low, close to zero, and that wasn't really true of the U.S. until fairly recently. So basically what was happening is that traders would do this. They would borrow in a low interest rate currency, typically the yen, and then lend in a high interest rate currency, the dollar. But here's the thing. They did not enter into a foreign exchange forward contract because that would have eliminated all of their profits. So instead, they just hoped, they hoped very hard that the yen would not appreciate. And I'll show you why in a minute. These traders were gambling that the yen would not appreciate, because that would have not only wiped out their profits, that could have caused them to suffer losses. So how could they be so confident that this wouldn't happen? Well, let's just take a little detour here and explain how and why this might be the case. Hold on. All right. So why were traders so confident that the yen would not appreciate? All right. Well, here's what's going on. And we'll see a lot more of this later on in the course. The central bank can strengthen its own currency by selling foreign currencies and using the proceeds to buy its own. So we'll explain this in a lot more depth in a later chapter. Now, the question is, why would they do this? Okay, well, at this point in time, now keep in mind, this is probably the 80s or the 90s. What was going on in Japan? Well, the Central Bank of Japan knew that without interventions in the foreign exchange markets, the yen would tend to appreciate against the dollar. Okay, because at this point, so their car sales are through the roof, and everything in Japan's really chugging along. So the yen would tend to appreciate. Now, this meant that Japanese exports would become less competitive in world markets. As a result, trade surpluses would shrink. Now, why would this be a problem? Because, as we've seen already in this last week or the week before, when this happens, as the trade surpluses shrink, due to the stronger yen, two things would happen. Unemployment would rise, inflation would fall. Now, you might say to yourself, well, that's the trade-off you'd expect. But here was the thing, though. Japanese inflation was and still was already close to zero. If it fell further, Japan could have experienced what we call deflation, which in some ways is worse than inflation. You might not think so. You might say, well, that might be a good thing, having falling prices, but deflation harms borrowers and helps lenders, so that it can have, it can cause the economy to slow dramatically. Now, the last time we had deflation in the United States was during the Great Depression. So that tells you what can happen. It means that if you borrowed money, you have to repay it in, you're actually paying back more in real or inflation adjusted terms. And that's why so many farmers lost their farms, because, their loans were locked into place, but the prices they were getting for their crops kept falling and falling. And so it caused sort of a chain reaction, and then there's failures by farmers and failures by banks, and it starts feeding on itself. So deflation is something that most central banks try to avoid if possible. So Japanese inflation was already at the edge there, and so they did not want to find their inflation rate falling any further. And then in addition to that, in Japan at least, always by tradition, the central bank has always focused on keeping unemployment as low as possible. Okay, so therefore, a stronger yen could have not only pushed the economy into deflation, deflationary territory, I should say, it could have also increased the unemployment rate. So this is something they don't want. In other words, as far as they're concerned, a stronger yen is a problem. So what that meant was, as a result, the Bank of Japan, for many years, maintained a policy of deliberately weakening the yen to keep it from getting too strong. And as long as traders did not expect this to change, they could be confident that they would make money with uncovered interest arbitrage. And so let me show you with a graph what this is all about. So this is what the yen carry trade means. American traders borrow yen at the euro yen rate, which is really low at the time compared to the dollar, convert those yen into dollars at the spot exchange rate, deposit them at the euro dollar rate, and then in the future repay the yen loan. In other words, take some of those dollars, turn them back into yen, and repay the yen loan. And if nothing went wrong, this should have resulted in profits. So let me see, I think I have a numerical example here. Yes, good. So here's how this would have worked. So currently the spot exchange rate between the dollar and the yen is 100 yen per dollar. And you see the two respective euro currency rates are 3% for the dollar and 0.5% for the yen. So this is what clever American traders would have done. All right. So they're going to borrow those inexpensive yen and lend them out in dollars. For example, let's say that they decided to borrow 10 million yen for 180 days at the Japanese rate of 0.5%. Now here you notice I'm dividing to turn that into $100,000. So if I deposit that in a euro dollar rate, I'm getting 3% for 180 days. Now you can see I'm borrowing at 0.5% and I'm lending at 3%. Not too bad. I mean, it looks like I'm going to make money. Well, what could go wrong? What could go wrong is when I convert my yen back into dollars, a stronger yen could wipe out my profits. And I'll show you how in a minute. All right, so if nothing else goes wrong, so in 180 days, the dollars are going to be worth 101,500 because that's basically half of 3%. So I've got my 101,500, but I have to repay that loan. How much do I owe? Okay, well, we know how much it is in yen. So with no change in the yen, first of all, with an interest rate of 0.5%, that means I only have to pay 25,000 yen worth of interest. So my $10 million yen loan now requires me to repay 10,025,000 yen. So here I'm assuming, to keep it simple, that the exchange rate hasn't changed. And that means that this amount of yen is worth $100,250. So is that good or bad? Well, remember, I only paid back on my loan, my dollar deposit was worth 101,500, of which I've repaid 100,250 on my loan. So the difference goes into my pocket. Okay, I've just made $1,250 from the yen carry trade, which is also known as uncovered interest arbitrage. All right, let's look at the graph. I think you'll find it easier to follow with the graph. So again, we start with the yen. We're starting in the bottom left-hand corner. I'm converting 10 million yen into, with this spot exchange rate, into $100,000, which is then deposited for 180 days in the euro dollar market, which means that in 180 days, I'm guaranteed to have $101,500. And with this exchange rate being unchanged, I now have 10,150,000 yen, but I owe 10,025,000 yen. So guess what? The difference goes into my pocket. All right, how much did I make? 125,000 yen is my profit. And, no matter how much they're worth, in dollars, that's still a nice profit. Now, here's the problem. What if the yen got stronger? Suppose, for example, it appreciated to, let's say, 80 yen per dollar, which, remember, that means a stronger yen because it takes fewer yen to buy a dollar. Now, I take this amount and divide by 80, and let's see what I get. Sorry, I'm not dividing, I'm multiplying. So $101,500 times 80 yen per dollar. How much is that worth? Oh no, I'm almost afraid to look. 101,500 times 80 is only 8 million. Oh my God. 8 million 120,000 yen. So that's how much I have. This is how much I owe. I just got clobbered. I just lost 2 million yen. All it took was for the exchange rate to appreciate by 20%. Now that's a lot, but currencies are very volatile. It's not impossible. And guess what happened? I just lost 2 million yen. All right. And 2 million yen, how many dollars is that? Well, it's only $25,000, but it's a big loss compared to making a nice little profit. So the stronger yen would mean that I'm going to lose money. But I'm so confident that the Bank of Japan won't let this happen that I can go right ahead and enter into this trade, knowing that they're not likely to allow this to happen. If the Japanese central bank sees this happening at that time, at least in history, they almost certainly would have strengthened it, or weakened it back to at least 100, if not more. Okay. In fact, if this goes up, my profits will go up even further. If, let's say, it goes up to 110, I'm going to make a lot of money, because now we're looking at 11,165,000 yen. So I can't wait. This is fantastic. If it goes up, I'll really make a lot of money. But because this is risky, the word arbitrage, as it was often applied, is not strictly speaking correct, because arbitrage implies no risk. Here there is a risk. The Japanese central bank could change their minds and just let the yen go down to 80, and I'd be in a lot of trouble. So the name uncovered arbitrage is not technically correct, but most economists would have called it the yen carry trade anyway. Well, that's what that one is all about. Now, interestingly enough, a lot of traders, because the US and Japanese rates are so close to each other now, have turned their attention to other currencies, like the Australian dollar, for example, where maybe, just maybe, they can still get into a similar position here if they think the Japanese central bank will not let their exchange rate change with respect to that country. But it's still a gamble, any way you look at it. There's no getting around it. This is a gamble. All right, so it's related to covered interest arbitrage, but it's not completely the same thing. All right, so anyway, yes, that was a lot of complicated calculations. What's coming up next is a little bit different, because now we're going to take a step back and ask ourselves the following question. Where do these spot exchange rates come from in the first place? Interesting. Now, there's a lot of theories about that, of course, but this book takes an interesting approach. They're going to introduce something called the asset approach to exchange rate determination, which means we're going to treat currencies as financial assets, just like stocks and bonds. In other words, we're going to treat them as if they were seen by investors as investment opportunities. In other words, if I'm an investor, maybe my best bet is not to buy stocks or bonds, but to put my money in Japanese yen or British dollar, sterling rather. So by treating these as financial securities, what will follow will make a lot of sense, because essentially what we're trying to do is explain exchange rates in terms of rates of return. Okay. In other words, we're going to pretend that the only reason people buy currencies is to get the highest possible rate of return. And the entire model is based on that notion that currencies are just another financial asset that we can invest in. Okay. Now, remember, I showed you before, the daily trade is over $5 trillion. Actual trade in goods and services is only a tiny fraction of that. So the rest, must be coming from somewhere else. And according to this theory, that somewhere else is investors trading these currencies to obtain the highest possible rate of return. So it's a very interesting idea. Okay. So anyway, the logic here is that in the short run, interest exchange rates are assumed to result from the interaction between the demand and supply, not for foreign goods and services and domestic goods and services, but financial assets. By the way, later on, we'll see in the book that for the long run, we're going to assume the opposite. We're going to assume that the main motivation for holding exchange rates is to buy foreign goods and services. But in the short run, most of this activity is driven by this search for the highest possible rates of interest. Okay. So we're assuming that investors are trying to find not just the highest rate of return, but the highest real rate of return, which, as you know, means adjusted for inflation. So wherever they can maximize the real rate of return, that's where they will want to invest their funds. It doesn't matter what country it is, wherever we can maximize the real rate of return, that's where we will find ourselves. Okay, so that being the case, the ultimate factors that determine our exchange rates are domestic and foreign interest rates, domestic and foreign inflation rates, and finally, our expectations of what to expect from those currencies in the future. All right, it's a very interesting model that we'll be developing, and it also will give us an opportunity to develop some graphs, which we haven't really done a whole lot of graphs yet. And you'll see, when you see these graphs, you'll see that they remind us a great deal of supply and demand curves, but they are different in a lot of important ways. So this is where we're headed. All right, so I think since we're diving into a completely new topic, why don't we have our break right now? And when we come back, we'll dive into this idea of how to determine exchange rates in the short run by treating them as financial assets. All right, so let's relax for a bit. And when we get back, we'll be looking more deeply into this model. All right, let's do it. All right, let's do this. All right, so what's going on with this model? So, oh, and by the way, I forgot to show you this slide. Expectations are determined by many different types of economic variables, um, like inflation rates, GNP growth rates, monetary policy, fiscal policy, but also from many different non-economic factors like central bank credibility, political upheaval, financial crises. So in other words, expectations are largely driven by confidence, among other things, and that can change very, very quickly. As you can see, you know how like the Dow can go through a very strong period and then suddenly it's falling like crazy. And you wonder how confidence could have switched so quickly. But yes, confidence can change at a moment's notice. So because of that, expectations can fluctuate. And therefore, if exchange rates are being driven by expectations in the short run, that would explain why they're so volatile. In fact, if you want to see some examples of this, we could go to a website called FRED, which is the Federal Reserve Economic Database, and it is uh, implemented by the St. Louis Fed. And we can look at, for example, the pound dollar exchange rate just to see how much exchange rates bounce around over a fairly long period of time. So look at this one. You can see there's a lot of up and down movements, and this is only going back to 2016. Let's go back 5 years. I guess that is 5 years. Let's go back 10 years. Oh, not as much. But okay, but you can see in the long run, right now, the pound dollar exchange rate is about $1.40, which is up a bit, as a matter of fact. You might recall that after Brexit, it got as low as about, look at that, $1.22. But then throughout much of the recent, let's say, couple of decades, it's typically been right around $1.60, $1.70 per pound. But there have been other periods where it got unusually strong. Like here, it got up as high as 205. And then there's been other periods when it was quite low. In fact, I soon remember that somewhere along here, it briefly fell as low as like, it was at one point, it was just barely above $1. So you can see now, a lot of this is driven, of course, by economic crises and special events like Brexit and other issues too. But you know, the fact that it bounces around so much, this exchange rate, is an indication that something else is affecting the exchange rate, and that something else is usually assumed to be changes in consumer sentiment or expectations. And no matter what exchange rate series you choose, you're going to see something similar. They're all very volatile. And so the model that we're about to develop does try to explain why this is actually happening, among other things. Okay, so like, I don't know, how about this? Let's look at the euro for a second. Dollar, euro. And let's see what this has looked like in recent history. Let's see. Yeah, see, it's kind of the same thing. It's sort of this up and down pattern. And the euro, if you go back far enough, you can see that it's been as high as, ooh, $1.58 here. This is during when the credit crisis first broke out in the United States. But then there was a brief period when it was as low as roughly 85 cents, fairly soon after it was introduced in January of 1999. All right, so anyway, so let's get back to what we were doing. And also, I just remembered that I'll tell you what I'm going to do here, because we're talking about exchange rates anyway. We're going to look at this model, but I found this an amazing video that I'd like you to see, which is more about the euro currency itself. In other words, the notes and coins. And I think you'll find it extremely interesting. But for right now, why don't we focus our attention on the different factors that influence exchange rates in the short run. And then towards the end, I'll get out the video, and I think you'll be amazed. All right. It's an extremely interesting video about euro notes and coins, which, you probably didn't even know about half of this stuff. It's that interesting. All right. So anyway, so because expectations are a major component of the exchange rates in the short run, any new economic information, any new developments in the markets can have a large and immediate impact on exchange rates. Okay, more so than many other financial assets. For example, bond prices don't tend to bounce around so much because they're driven by interest rates, which are fairly stable. Sometimes stocks act like this, but really exchange rates are probably one of the most volatile of all the financial assets that we could buy. So expectations, because they can change so quickly, that can help make exchange rates very volatile. Now, by the way, we're going to make an assumption here that we're only comparing currencies that are more or less equally risky. All right, if that's not the case, we have to make some adjustments to this model. Like, for example, if I'm comparing the dollar and the pound, or the dollar and the yen, the euro and the yen, those are all fine. But if I'm going to start looking at the dollar, let's say in the Turkish lira, that's a different ballgame, because clearly the Turkish lira is much riskier than the US dollar. And then we have to make adjustments to this model for what's called a risk premium, which what it basically means is that investors would require a higher rate of return to hold Turkish lira than US dollars. And that has to be taken into account as we try to explain the relationship between the dollar and the Turkish lira. So here, we're just going to focus on the very strong currencies, the major currency pairs, so we don't have to deal with this, but we will come back to this later on. So this is all collectively known. What we're about to do is the asset market approach to exchange rate determination. And like I basically said before, what we're essentially doing is treating currencies as another type of financial asset that investors could buy and hold, as opposed to, let's say, stocks and bonds. All right. Now, also in this day and age, what's interesting is that it used to be very difficult and awkward for Americans to buy foreign stocks and bonds or hold their funds in foreign bank accounts. Now it's actually quite simple. It's not hard at all. And so because of that, that's going to make exchange rates even more volatile, because a lot of investors will find themselves shifting their funds around between different currencies as market conditions change. Okay, so what we're assuming here is that it's possible, and in fact easy, to quickly switch our funds from one type of currency to another, and in the process, that should affect the exchange rate between those countries. So if Americans, for example, switch some of their dollar holdings into euro sterling, that will affect the exchange rate between the dollar and the pound. Or if it's the other way around, if investors switch some of their euro sterling into dollars, that's also going to affect the exchange rate. And we're going to assume that this is happening on a regular basis. In fact, that may be one of the reasons why we see so much trading in these markets, for the simple reason. Let's go back and look at that chart again, which I hope you found sufficiently shocking. $5 trillion a day. I don't know what percentage of that is due to trade in goods and services, but it's not a huge percentage. What is going on with the rest of these? It may very well be that investors are simply switching from one currency to another, and in their quest to find the highest possible rates of return. Okay, and that may be all there is to it. But that's an awful lot of money, isn't it? I mean, really, $5.3 trillion every single day. All right. Anyway, let's get back to this. So here's the equation that we'll be looking at. Now, what exactly is going on here? Well, first things first, you might remember, if you've had an economics class, let me just remind you that in economics, we use the word equilibrium pretty frequently to describe a lot of situations. One in particular is very important, and that would be the balance between what we call supply and demand. And so what do I mean by that? Imagine that this is the market for a product. It could be literally anything. Let's say it's the iPhone. So we have a demand curve, which is downward sloping, which indicates that as the price of this product falls, people will be willing to buy progressively larger quantities of it. The supply curve comes from the producer, and the upward sloping supply curve tells me that as the price goes up, the producers of this product are willing to sell progressively more units. And so where they meet, right here, we establish what's called an equilibrium price and an equilibrium quantity. And so this E stands for equilibrium, which means there's a balance between the quantity supplied and the quantity demanded. I'll call that QS and QD. Right at this price, the amount that the Apple is willing to produce and sell to the public exactly matches the amount that the public is willing to buy. And so that means everybody's happy. We call this equilibrium, which indicates there's some type of balance here. And that balance is between quantity supplied, quantity demanded. All right. So if something comes along to disturb these supply and demand curves, then this position will shift. But right now, at this point in time, E represents the equilibrium price and quantity in this market. So why am I bringing that up now? Because we're going to see something similar with this asset market approach. What we're looking for is the equilibrium exchange rate between two different countries. Okay, so this is what we will call an equilibrium model. And you'll note here that this is not a no arbitrage relationship like we had before with covered interest arbitrage. It simply means that in equilibrium, when everybody's happy, this is the relationship that should hold. If not, let's go back to this graph. If we're not in equilibrium, let's say that, for example, the market price is too low. It's down here somewhere. Down here, the quantity demanded exceeds the quantity supplied, and that means there's a shortage of the good. And so what will happen is the price will rise until we reach the equilibrium level. Then the adjustments will stop. If the price was too high in the first place, we've got the quantity supplied greater than the quantity demanded, which means we have a surplus. And as a result, the price will drop until we reach the equilibrium price. And then everybody's happy again, and there's no need for the price to adjust. So in an equilibrium model, if we're not at equilibrium right now, there's an automatic tendency to move back towards that equilibrium position. And this is no exception. So this is with our traditional supply and demand curves. But in this asset market model, what we're saying is that we're developing an equilibrium relationship between two currencies, which if it does not hold, there's an automatic tendency for variables to adjust until the exchange rate is back at its equilibrium level. All right, so that's what this is all about. It's an equilibrium model. And if this relationship doesn't hold at any point in time, it's understood that it will automatically gravitate back towards, in other words, the exchange rate will change until we find ourselves back at equilibrium. All right, now RD is meant to represent the domestic rate of interest. And RF is the foreign rate of interest. And then E is the spot exchange rate, but we have to be careful here. It's going to be quoted as so many dollars per unit of the foreign currency, not the other way around. If it is foreign currency per dollar, then we have to change this equation. So we're going to stick with this equation throughout the chapter, which means that all of our examples were are going to be based on the price of some foreign currency in terms of dollars. All right. So, like we saw earlier with the interest rate parity condition, if that is not the case, we have to adjust the formula. So here, let's keep our lives simple. Let's assume that this is always dollars per unit of foreign currency. Now, here's something new. E with a little tiny e superscript. This E means that this is the so-called expected spot exchange rate. What does that mean? That's the consensus in the market as to where this exchange rate is going in the future. Now, you might say, well, how can there be such a consensus? Well, what happens is if you look, I don't know who actually does this. I think, let me just double check real fast, but there are surveys that are constantly being sent out to participants in the foreign exchange markets. And let's see. I'm trying to see if there's any one source. I'll look at these questions. All right, let's write it this way. How are foreign exchange expectations determined? Yeah, see, it mentions here exchange rate expectations, but they don't, I'm not seeing where they're specifically explaining, but there are surveys being done all the time. And so imagine that most of the people trading in a market think that, for example, next year it'll take $1.70 to buy a pound. We could think of that as our expected exchange rate. Now, if not, there are other ways we can do this. There are models in economics of expectations that we could use. For example, we have a model called rational expectations, which we could use if we choose to do so. If we really believe that investors hold what we call rational expectations, then there is a specific way we can forecast their expectations. And you can see it's a very complicated process. We're not going to do that here, obviously, but there are models that we could use to come up with a number for this expected exchange rate. The other option is to use surveys of the market participants, but we're going to assume that there's a number that we can point to and say, this is what investors expect to happen in the future with this particular currency pair. So we're assuming that it can be done. And so with all that in place, what we're going to do now is change this. We're going to assume now that it's the dollar and the pound. And oh, by the way, now here's another important detail. If, let's say this is the dollar and the pound that we're looking at here. What this equation is really saying is this. The left-hand side represents what kind of return we can hold as Americans from keeping our funds in a euro dollar account. It's a known quantity. There's no risk. What's going on the right-hand side is a little different. Okay, so let me just copy this onto the next slide. So we're saying that RD in equilibrium equals RF plus this expression EE minus E over E. So this is the known return to investing in dollars. Okay, by the way, let's do this. Let's change these symbols. If we're going to assume that this is dollars and pounds, let's replace that D with dollars and the F with pounds. Just remind ourselves that this is the dollar pound exchange rate. And in addition to that, these exchange rates E are quoted as so many dollars per pound. All right, so on the left-hand side, we have the known return to investing in dollars, specifically euro dollars, assuming that we are American investors. Now, what's going on over here? Well, we're going to see why in a minute, but the right-hand side is what we're going to call the expected return, keyword being expected, to investing in euro sterling. Now, as an American investor, if you notice, we're not using a forward contract to lock in the return to the sterling, because if we do, the left-hand side of this equation and the right-hand side will automatically equal each other. And that kind of defeats the whole purpose of switching your funds into euro sterling. If you're going to use a forward contract, you might as well leave your funds in the euro dollar. So we're assuming here that we're not doing that. We have the choice of either holding euro dollars or euro sterling with no forward contracts. So that means we don't know what the return will actually be. But we think we do have some idea of where the exchange rate is going in the future. So these two terms actually give us the total expected return to the euro sterling. And so basically, what these two terms represent is the following. Our pound is the return in pounds to holding euro sterling. And this piece is referred to as the expected appreciation or depreciation. I'll write it as appreciation / depreciation of the pound against the dollar. All right, so in other words, if you're going to hold euro sterling and the exchange rate never changes, then your rate of return will be the euro sterling rate of interest. It's only because the exchange rate could change that your return could be different. So if that's what you think, I mean, if you really think that the exchange rate won't change, then you'll be getting this as your rate of return. But other events will cause it to be different. So in fact, why don't we look at this more closely and see when you might choose to invest in the two currencies. So for example, let's look at this for a second. Suppose, let's write this down again. If the EE term is greater than this E term, then this entire expression will be positive. And guess what that means? This entire right-hand side will exceed the left-hand side. And that means investors will switch funds from euro dollars to euro sterling because they believe that they'll get a higher return that way. Because remember, the left-hand side is the return to the dollar. The right-hand side is expected return to the pound. So if this EE is greater than this E, this entire expression in parentheses is positive. The right-hand side of the equation will be greater than the left, which means you're better off holding euro sterling than euro dollars. And according to the model, as people switch their funds, these will adjust until the two sides are equal to each other again. Okay. Now, what if the opposite is true? We have this as our starting point. If investors expect the opposite, then this term will be negative, and that means that the right-hand side, the left-hand side rather, will exceed the right-hand side. And therefore, investors will want to do the following. They'll switch from euro sterling to euro dollars until the exchange rates adjust and the two sides are once again equal to each other. So you can see that based on this model, if our expectations change, that will mean that funds are flowing out of one country into the other, and that might help account for a lot of that $5 trillion worth of trading that takes place every single business day. All it takes is for people to change their minds, and before you know it, funds are flowing out of one country into the other, or from one currency into the other. And before you know it, we've got $5 trillion being traded because maybe everybody changed their minds about the strength of the dollar or the strength of the pound. And that's all it takes. So in a nutshell, that's driving a lot of this model, but we also will be allowed to see what happens if one country's interest rates change and the other doesn't. Because you'll see changes in the two interest rates will also have a direct impact on the strength of the two currencies. So that means we can analyze monetary policy, which we will down the road, and see how that affects the exchange rates between two different countries. All right, now with all that being said, let's go back here and we'll notice here that if you look at this equation, the right-hand side is these two terms. This is the foreign rate of interest. In our examples, it's been the British pound rate, but this is the expected percentage appreciation or depreciation of the foreign currency. If EE exceeds E, as we saw earlier, that means that this entire term is positive, and that means we expect the dollar to depreciate. Okay, because remember, if we're talking about dollars per pound, let's say that we currently have $1.50 per pound and EE is, let's say, $1.60. That implies that we expect a weaker dollar. And that means that the return to the pound will be higher than the dollar. All right. So in other words, if we really believe the dollar is going to go downhill next year, we're probably better off buying euro sterling because we'll profit from it. All right. Now, clearly, if the opposite happens, then we would expect the dollar to be stronger and we're better off holding dollars than pounds. And that's exactly what people will do. All right. Now, let's see. Now, we got some numerical examples here somewhere. So, yeah, that's the case we just looked at. EE, wait, let me do it like this. It means the same thing. The dollar is expected to weaken against the foreign currency. that means that we would be better off holding the foreign currency. Okay. So if we're looking at a weaker dollar, we should probably shift our money or funds from euro dollars into euro sterling. If we believe the opposite, then of course this means that the dollar is expected to appreciate and therefore we'd be better off keeping our money in the United States, or in other words, in a euro dollar deposit account instead of euro sterling. All right, now luckily I have a numerical example here so you can see exactly what's going on. I mean, it's easy, it's one thing to say, sure, I get this in the abstract, but when you see a numerical example, you'll say, oh, I get it now. All right, let's take a look at this example. So a US investor has the opportunity to invest $1,000 for 1 year in a British bank account that offers a rate of 5%. So that's the euro sterling rate. The exchange rate is currently $2 a pound. Okay. So what we're going to do is decide what to invest in based on two possible expectations for the future exchange rate. In other words, we have two different scenarios here. And in one case, we expect a weaker dollar in the future. And in the other case, we expect it to get stronger. All right, so let's start with a case where we expect a stronger dollar in the future. So if I start by converting my dollars into pounds, I'll get 500 pounds. Okay, now once I have my 500 pounds, I'm going to invest them at the foreign rate of 5%. Now remember, I'm not using a forward contract because that again would reduce my return to whatever I can get in the US. So I'm looking at a 5% rate of return in England, which would bring my deposit up to 525 pounds. Now, this will be true in both scenarios, by the way. Where they differ is right here. What happens when I convert these back to dollars? So if I'm expecting a stronger dollar, meaning $1.90 per pound, what will happen to this deposit? Well, let's find out. If we multiply 525 pounds by $1.90 per pound, how many dollars will that be? Ooh, that's pretty painful. We actually lost money by putting our money in euro sterling. All right. Now, on the other hand, what if we had been pessimistic about the dollar and we expected it to go up to 210? Yeah, look at that. We're expected to lose 0.25%. But if we were expecting a weak dollar, meaning $2.10 per pound, ooh, that's a nice rate of return. We're getting 10.25% because of the weaker dollar. So you can see where this is going. Anytime we expect a weaker dollar, we should probably hold pounds instead of dollars. If we expect a stronger dollar, it would be the other way around. So you can see why even a very quick, change in our expectations could lead us to switch our funds from one currency to the other. And this is, in order to do that, we have to make two transactions in the foreign exchange markets. And so therefore, that could contribute to that daily $5 trillion. All right, I'll tell you what. I want you to see that very fun video that I showed one of my other classes today. It's all about the euro notes and coins. I think we deserve a little levity after all of this very serious discussion. So what I'm going to do is go find that link. Hold on one second. And you're going to be talking about this at work tomorrow, I guarantee you. That's how interesting this is. Oh, yes. I can't wait to show it to you. Now, the only thing is we have to watch it here. You're going to have to watch it on your own individual computer screens because first things first, I mean, if I show it here, it's been my experience that you might not be able to hear it. And secondly, um, we might be violating copyright laws by doing this. So what I'm going to do is while it's playing, I'm going to pause the recording. Okay, so you have to watch it on your own computer. And hold on one second. There we go. Now, at long last, you're going to see something amazing. It's called The Secrets of the Euro. All right, here we go. I'm going to put it up here in the chat room, and you tell me if this isn't the most amazing video you've ever seen in your life. Okay? All right, here we go. There it is in the chat room. Let's take a look at it. Common Bond has made it so that I don't have to focus on All right. So was that fun? Yeah, I told you what was going to happen. You go to work tomorrow and tell somebody that there's a €0 bill out there floating around, and you see how they react to that, or that the lines on either side of it, the bills line up to make sure that they're not counterfeit. Um, so anyway, but I thought you'd find that interesting. And let's face it, we should have some fun once in a while too, even though this is a serious graduate class. But anyway, I do have others, and I'll try to sprinkle them throughout the course as I see fit. But I think you'll agree that was definitely worth our while to watch it. So anyway, why don't we knock it off right here? I think we don't want to dive into the next section of these notes that we're about to look at is going to get fairly complicated in a hurry. So there's going to be a lot of graphs, and oh man, I think maybe we'll stop right here and we'll pick it up when we come back next week and dive into this model, and we'll develop some graphs, and we'll do all kinds of fun stuff. So in between now and then, I hope you have a good week, and I'll see you next Thursday.
All right. Have a good night, Professor.
All right. Good night.
Good night.
Professor, have a good one.
Good night, Professor.
All right. Bye.
Good night. Bye.
All right. See you later.